Hi, this is Nicholas Vardy of the Oxford Club, and welcome to this week's edition of Buy or Buy. In this series of videos, I take a popular stock making the media rounds and I strip away all the hype, and I tell you whether you should buy now, buy later, or buy never. This week, I want to take a look at one of the original tech giants, Microsoft. Now, Microsoft, by any measure, has had a stellar run over the past few years. In fact, the stock price increased by 55% in 2021. That actually marked the 10th straight year that Microsoft had a positive year and the 9th straight year with a double-digit gain. That is quite a remarkable track record. In addition, over the past 5 years, Microsoft delivered an astounding 441% return to investors. On the way, Microsoft actually crossed the $2 trillion mark, briefly making it the most valuable company on the planet. Now, while Microsoft saw a tremendous 2021, it has had a rough start to 2022. In fact, a recent 8% drop in the stock price just over the first couple weeks of January marks its worst performance since the start of the global pandemic back in March of 2020. Investors are now scrambling to figure out whether this is just a short-term pullback or whether Microsoft's long-term decline has begun. So, is Microsoft a buy or buy, or should you wait before placing your bet? Founded in 1975 by Bill Gates, who had dropped out of Harvard, Microsoft, of course, is a software company, and it's known for a wide range of products to consumers. Its best-known products include Office, Skype, Outlook.com, LinkedIn, and Microsoft Teams. Microsoft also offers Azure, a cloud platform that has become a leader in the global cloud space. Let me start by making the bull case for Microsoft. Now, Microsoft is not the business that you think it is. Many investors still associate Microsoft with Windows and Office, but Microsoft has other booming businesses as well. Just this week, Microsoft announced a $75 billion bid for video game giant Activision Blizzard, sending the shares of rival Sony, the maker of PlayStation, down by 10%. Microsoft remote conference software Teams has become a blockbuster hit for the company, generating double-digit revenues and profits over the past couple of years. In fact, I personally wouldn't be surprised if at one point Microsoft decides to acquire Zoom once the air is let out of that bubble. Microsoft is also an early mover in the red-hot and much hyped metaverse, an industry that is expected to generate $800 billion in revenues by 2024. But it's really the Azure cloud infrastructure service that has driven much of Microsoft's gains in recent years. It has become the most daunting competitor to the market leader, Amazon Web Services. Now, Microsoft doesn't separate out Azure earnings. However, it did report that revenues in Azure grew by 50% this past year, continuing a period of double-digit growth over the past couple of years. In fact, some are even suggesting that Microsoft should spin off all its other industries and become purely a cloud-focused business. Now, Wall Street is certainly bullish on Microsoft. Investment bank Credit Suisse expects Microsoft earnings to grow between the high teens and low 20s, boosted by its ongoing share repurchase program, notably a $60 billion program that was approved by the company's board of directors back in September of 2021. Credit Suisse analysts have set a price target on Microsoft of $400. Given that Microsoft is trading around $300 as of this recording, that's close to a 33% upside in the stock. Let me set out the bear case for Microsoft. There are analysts who are less bullish on the Redmond, Washington-based company. They highlight the part of the company's business that is subject to a lot of competition. Google Apps, as you may know, offers a free alternative to Microsoft's well-known Office platform. Microsoft's metaverse offerings are still nascent, and in fact, some of its staff has been poached by Facebook in recent weeks. There are other macro trends that do not favor Microsoft, such as a potential turnaway from big tech, which is what we have seen over the past couple of weeks. After rebalancing of the portfolios by tech investors, this could negatively affect the price of the stock. Finally, Microsoft is, even after its pullback, is not a cheap stock. Its price-earnings ratio is close to 35, suggesting that a lot of the growth in the company is already factored into the price. Now, before I reveal my final verdict, let me remind you to subscribe to my free e-letter, Liberty Through Wealth, which I contribute to about twice a week. There you'll have a chance to hear more of my mostly contrarian insights into markets and what drives them. Now, back to Microsoft. Is Microsoft a buy or a buy? I think Microsoft is a buy. The company's strong market position, its prospects for growth, and deep pockets, as demonstrated by this week's Activision Blizzard bid, put it in a strong position to thrive in the years ahead. The downsides for the stock are a rotation out of tech, the company's valuation, and the risks involved in developing its metaverse businesses. Overall, it's hard to go wrong with Microsoft stock. You should view any pullback in the stock as a terrific buying opportunity. I hope you enjoyed this edition of Buy or Buy. If so, please click the like button below. And I want to remind you that these are not formal recommendations that are being tracked in any formal portfolio. So if you do take my advice in any of my videos here, make sure you size your position accordingly, set a trailing stop, and never bet more than what you can afford to lose. Thanks for watching, and I'll see you next time on Buy or Buy.